All right, let's talk about Goldman Sachs. So here's the fun statistic we got. Normally they get a lot of $100 million revenue trading days. They only had 4 last year in 2007. I was shocked by how low that number was.
Well, first of all, it's such a cool way to measure, I think. This is the Wall Street nerd in me looking at this. But so 4 versus 2009 when they had 131.
So that's the number that jumped out at me. They had 131 days of $100 million?
Right. That's a pretty good year.
But what's also interesting is that basically the bid-ask spread seems to be narrowing so much because they're getting so much competition from other people. So there could be ways that they could basically do a trade and not get a fee and not make any money off of it just to keep the business.
Let's also remember that 2009 was a very difficult year for the markets. The economy was not doing great. And we've been talking about this since the start of the year, especially when we've had these massive up and down swings in the market. Banks thrive on volatility, and especially a desk like this thrives on volatility. So it'll be interesting to look at this number a year from now and see if 2018 there are a couple more $100 million days.
Totally right. At the same time, to your point, it's interesting whether ETFs may have changed all of this, where you have a lot more algorithms trading, and it's a different world, and other non-banks participating in a lot of this business.
Well, sure, but also there's just no volatility. So no one's actually trading. So you literally need to scramble for the 4 people who want to make a trade at the end of the day. So we'll be interesting to see how it pans out for this
And
one,
we've seen those numbers play through not just at Goldman, but in other places with the low FIC trading, or low FIC revenue and profits, I should say.